Warren Buffett said, the true investor welcomes volatility. But I suspect that among the people in this room, there are some who are feeling a bit more apprehensive, perhaps, than Warren Buffett is right now. And I don't blame you. Yesterday was an interesting day for US stocks. And in fact, this year is shaping up to be the jumpiest since at least 2015 in terms of equity vol. It's not hard to see why. Every day on Twitter, we've got wars of words among corporate CEOs, world leaders. We've got an actual real live trade war brewing among multiple countries. There's political risk in Turkey, in Italy, here in the UK. And of course, in the background, we've got this specter of rising interest rates that has been spooking investors all year. So for many investors and for many users of ETFs, this is going to be among the first time that they're using ETFs when markets are as volatile as they are today. And so for this morning's panel, we're going to ask how volatility is affecting how investors use ETFs, and should it? And if so, how should it? And we've got a great group here to help us parse these suddenly urgent questions. So without further ado, to my left, we've got Will Hobbs. Will is head of investment strategy at Barclays, where he works on tactical asset allocation for the bank's wealth management and private bank clients. He's been at Barclays since 2005, so I'm sure he's seen his share of volatile days. So we look forward to hearing from you. In the center, we've got Bryon Lake. Bryon is head of international ETFs at JP Morgan. He oversees everything from product design to distribution, and prior to that, he spent more than a decade at PowerShares. So welcome, Bryon. And finally, last but not least, we've got Wei Li. Wei is head of EMEA investment strategy for BlackRock's ETF and index business, where she's responsible for generating ideas and also how to implement these via ETFs. So I'm sure she'll have plenty to say on this topic. So welcome all. And Wei, I thought we could start with you. And I think we've got a related question for the audience as I ask this, if we can pop it up there. So I listed a few things that have been sort of the drivers of volatility this year. As a strategist, what do you see is causing this year's volatility? And is this more of a temporary blip, or are we actually headed for a structurally higher volatility regime going forward?
Well, a regime change is a big word, but I can comment on some of the drivers behind certain bouts of volatility episodes so far this year. So 2018 has been very different from 2017 in that macro uncertainty has been on the rise, specifically in the US, but not limited to the US. So currently, if you think about what's been going on the growth front, on the upside, the larger than expected fiscal package and tax spending at the beginning of the year has certainly raised investor expectation in terms of how much further US growth can go. But on the downside, you talked about trade war, and the implication of that on companies, on economies is still just playing out. So because of this, tails are becoming fatter, uncertainty is increasing, and that is being reflected in markets as well. And against all of that, there is also the backdrop of central bank support being withdrawn. The Fed, at the beginning of the year, very little expectation in terms of the quarterly cadence of Fed rate hikes that is currently now fully in the price. And for next year, we could have another year of 4 rate hikes, but currently market is only pricing in 2. So this repricing of Fed policy normalization, as well as the fact that while withdrawing of the very loose ultra monetary policy support is causing nervousness in markets as well. And I think combination of that is what's been behind the volatility spikes. Now, having said that, for most part of this year, volatility has been hovering around in the low teens. It's not really that high.
Yep. Got it, yeah. And turning sort of to the ETF landscape, I mean, Bryon, you often hear from critics of ETFs that say ETFs have actually never been tested during volatile times. But in fact, people were using ETFs in 08, in 09, in 2011. So have we been here before, and what lessons do we take?
Yeah, so I don't know if you guys paint a super positive picture, but over the long haul, I think Warren Buffett says we'll all be fine as well, right? And so, as we think about the ETF as a technology, as a wrapper, Obviously, the first ETF was launched in 1993 in the US. If we have anybody from Canada in here, they've got a claim to an earlier ETF, but let's go with the SPY in 1993. And certainly there's been market volatility between then and now. I think 2000 obviously was a great example. 2008, obviously, once in a century kind of global financial crisis. And not only did the ETF wrapper itself prove to be extremely robust and continue to deliver in the way that investors expected it to, but actually what you saw from investor behavior is the ETF wrapper was even further embraced. So if you look at flows through the ETF wrapper, not specifically into quote unquote passive, but into the ETF wrapper, during market downturns, you actually saw continued persistence in flows despite potentially outflows in other wrappers. So you saw persistence in flows through the ETF wrapper, and then you actually saw it accelerate in years following that. And so I think that speaks to also the mentality of investors through market disruption, willing to embrace the newer technology and to use that in their portfolios. I also, just to kind of further the point, if we think about the ETF as a technology, as a wrapper, you can just as easily deliver US equities as you can US treasuries through the ETF wrapper. And so it doesn't necessarily mean that because markets have come off, ETFs have come off. Because the underlying investment is what's going to reflect your performance anyways.
Got it. So it's not necessarily the case that we paint all of ETFs with the same brush.
That's right, yeah.
And Will, I know you are a user of ETFs in your day job. And I mean, is that going to change now that vol is higher? Or do these continue playing a large role in investor portfolios?
It's going to play a large role, Yakob. I mean, one of the things, if you look at our industry, one of the only things we can really promise clients is fees. We hope to promise them professionalism, a convincing, profitable narrative, due diligence, all those kind of things. We can't promise them performance, but we can promise them fees. Now, in that context, you think about sort of, the effect that ETFs have had for private clients and all investors. In a sense, this is the best time ever to be an investor because the effect of the ETF, the proliferation of ETFs on the wider market in terms of fees, it's just load it and load it and load it, and so your net return from stocks, from bonds, has gone up. That's one of the reasons why you get a higher PE ratio. It's a very attractive sort of story for investors generally, and we will continue to use ETFs. We used them last Friday when we made a tactical change, and it facilitates our ability to trade in the market.
Great. Yeah, and actually we'll turn to that change a bit later, hopefully. Structurally, one of the things that's often touted about ETFs is how easy they are to go in and out of. There's a danger, like people like Jack Bogle of Vanguard have warned that because they're so easy to get out of, investors could potentially exit at the first sign of trouble. Is that a worry for you, or how do you kind of assuage that?
Well, I mean, if you look at the sort of, the academic evidence on this, there is some evidence that the proliferation of ETFs have created a bit more noise around security prices, but there also is plenty of evidence to suggest that they've helped price discovery as well. So it's not a clear message that you're getting so far. That's not been our experience either. And the other thing I think to think about with regards to our tactical allocation process is that what you tend to do is not think, can I do it, then should I do it? You think, should I do it, and can I do it, in that order. And so in a sense, the sort of, the ETF, sort of the implementation comes second. I think the third point to make is, in a way, the sort of that price story that you're talking about, really, it's a huge advantage for people to looking for, multi-year investment. People are just trying to get global GDP in their portfolios, and with as little friction as possible. So in a sense, you could argue very clearly, over the long term, that ETFs should promote long-term trading rather than increase the kind of, the dash for the exit that you see. But, time will tell. It's quite a new industry, as Bryon pointed out.
Well, and if I could just add into that, just because ETFs are more convenient to transact with, there shouldn't be a negative thing. And I think investors will adapt to that convenience and incorporate that into their decision-making process. I've got a bit of a trade war myself going on with Amazon Prime at my house. And so I'm trying to adapt to a new normal with that environment myself. And the convenience of Amazon Prime is something that's a bit of a challenge right now. And so I think in the same way, there's really smart investors like Will out there that are saying, these tools help me build better portfolios. I'm a fiduciary on behalf of my clients. And the more tools that I have available to me, the less friction I have when interacting with those, the more able I'm going to be, or the better I'm going to be at doing my job, which is delivering the right outcomes for my clients. And so I don't accept that challenge from Bogle that it like makes people trade too frequently because it's more convenient. I think that's a false logic.
I would also add to the very excellent points made here in that having choice is a good thing, and ETF as a price discovery tool is very different from it being a price driver. So a couple of stats to throw out there in terms of the penetration rate of ETF versus the underlying markets. In the case of equities, we're talking about 4% of the overall equity market, and in the case of fixed income, is less than 1%. So, to what extent it can actually impact markets, it's very clear to see.
So to put that in perspective, $5 trillion in ETF assets is about the exact same as the cumulative market cap of FANG, Facebook, Apple, Amazon, Netflix, Google, about $5 trillion. So it's a great point that you make, and just to kind of keep that in perspective for everybody, you can picture that. It's not that much.
And also, if you assume that the ETF penetration goes on much further, do you then sort of assume that actually it creates a new type of trader? Did these traders exist beforehand? There's sort of, the speculative style, and just that they now can trade more actively. There's some debate about that, and again, it's going to take some time to really sort of confirm.
Yeah, and Wei, so investors today, you were talking about the tools that ETFs provide. I'm assuming, and I know that we're well beyond sort of passive market cap weighted broad index tracking ETFs today. So what are the sort of latest technology we have in terms of ETFs for more sort of perhaps trading during more uncertain times?
I think over the years, in terms of the boundary between indexing and active is constantly being redrawn. So if you think about 30 years ago, for investors that were buying cheap stocks and selling them at more expensive multiples and calling themselves active portfolio managers, these days you can do that with value ETF. So as we continue to think about kind of what data we have available, what analytical capability that we have available, I think the boundary will continue to be pushed further to the right in terms of what kind of strategies we can now systematically index, right? So one of the trends that we have seen in the ETF space is that investors increasingly create rule-based strategies to be a bit clever about how to play the themes that they want to play. And on the back of that, we have the enormous development that we have seen in factor ETF, in thematic ETF, in ESG ETF, especially with better data as well. And what we also have seen as a trend in ETF investing is investors being very active with their indexing, with their ETF tools, being very selective with very granular exposures, being very tactical with kind of sector, country, rotation, and increasingly they're blending into this broad spectrum, and it's being used very holistically.
Yeah, I mean, factor ETFs have sort of been bubbling up for quite a few years now. Is this a time you think when they'll potentially break out in terms of popularity?
Break out in terms of the adoption?
Yeah.
Well, we have seen, to some extent, breakout of adoption in the US and in Europe already. We're seeing investors being very comfortable talking about how they use value ETFs to play steepener of the curve, and how they use a momentum ETF to try to catch on market trends and get exposure to technology, but not too concentrated in the funds, and how they use quality ETF as a potential way to stay invested in market, but in a more hedged way because it's higher quality. So investors are very well versed in how they use factors in building their portfolio, and I think the breakout that you talked about has already happened.
And Bryon, over at JP Morgan, I mean, how do you guys fight against this perception that ETFs are great passive trackers in calm markets, but perhaps inadequate for more active, volatile times? How do you guys battle that?
So I would probably frame the question differently, which is kind of how you started the question, which is there's this perception that ETF equals passive. And as I've kind of already said, we think of the ETF as a technology. It's a wrapper. And if we start with the objective that investors are trying to build better portfolios, and then as an issuer, it's our job to provide the tools to do that, we're going to leverage all of the different investment capabilities that are available to us. I'll give you an example. So when the first mobile phone was invented, it was transcendent technology, right? Picture Michael Douglas in Wall Street on the beach talking on that big shoe, right? It's this huge phone. It was amazing. And then now fast forward to now. We've all got a mobile phone in our pocket. None of us use it to make phone calls. We email, we text, we tweet, we Instagram, we vote on polls. But like making a phone call is just one of the things that we use a mobile phone for. And that's how we think about the ETF wrapper. It was a brilliant delivery mechanism for passive and still is. But there's a lot of different applications for the ETF wrapper that we think we can deliver through that. And so at JP, what we're thinking about is we're definitely delivering passive, plain vanilla. We call them our beta builder suite. We've got proprietary factor framework on multi and single factor framework. We're delivering those through the ETF wrapper as well. But we're also taking some of our flagship active capabilities and delivering those through the ETF wrapper. So we've got the biggest liquidity business in the world, outside of China, $625 billion in assets under management. We've asked that group to do a step-out portfolio. So folks that have too much cash in their portfolio right now that are looking to get a little bit more yield, or that have credit exposure that want to pull in some of their duration risk. And so we've got this ultra short suite that's seen significant growth. It's active. There's a human being with discretion over the portfolio that's making decisions in that portfolio, but it's delivered through the benefit-rich ETF vehicle.
Yeah, which obviously has the low fees, right, and the liquidity of the ETF.
Yeah, I mean, look, we could go off on a tangent, but I think fixed income delivered through the ETF wrapper is a killer app that's not yet been appreciated.
Yeah, so turning to a sort of tangential topic, and I think we also have an audience question on this too, because it can be a contentious topic. So Will, another way we can use ETFs is to directly bet on volatility, such as long, short, speculative hedges, income-generating strategies. As in your role at Barclays, do you ever recommend these types of products? And if so, I mean, how can they be used?
It is a contentious question. Yeah, so I mean, I think there's one thing. I mean, the short vol product has obviously got a bit of a bad name, but it's going back to that factor idea. So if we think that you should be paid a premium for providing insurance to the market, which is essentially what the short vol product is, then essentially there is merit in it if you think that you can access it. And that was one of the things that the kind of the XIV provided access to. The problem becomes when people forget what they're buying and why they're buying it, because obviously it's a negatively skewed trade. Just like all insurance provision, you see premiums roll in month after month, and then the thing that you're receiving premiums for happens, and you get that sharp, horrible thing. And actually, there were some permanent losses on this. So yes, I mean, as with all of these kind of factors that the guys are discussing, ways of providing access to investors for factors that could be durable, should be durable, as a way of sort of earning money, uncorrelated money in markets, that's very attractive to investors and should be. But you've always got, as with everything, ETFs, funds, whatever, you've always got to know what you're buying and why you're buying it and remember why you bought it. And I think, we got to the stage with that, the XIV, where we were talking about this just before, where we had the equivalent of the kind of, the proverbial shoeshine boy tipping the XIV, and you knew that some of the people who were telling you to buy the XIV were like, well, okay, that's time to sell. So that's one of the things you've got to watch for. Timing is everything, but yeah, they have a role.
And what about the long VIX products? Care to speak to those at all? As a hedge, as a portfolio hedge? It's
more difficult just because the shape of the curve generally means that it's eating your lunch before you get to eat it yourself, generally, which leaves you starving. So yeah, I mean, that's more difficult. And again, in that kind of, that volnado that took over markets at the beginning of the year, the levered long and the short vol products were part of the same story, weren't they? That squeeze in VIX, which kind of had those ripples down the chain and created an awful. So, again, you've just got to be careful about why you're buying it and know what you're buying.
I think that really goes to show the importance of having a very clear framework in understanding what kind of risks are associated with what kind of structures within the exchange-traded products. Not all of them are exchange-traded funds. And it's important to do the education. It's important to make it clear that they're different from traditional ETFs that most investors have.
Yeah, and in fact, I think the poll that was just up there showed a pretty even split between people who would use these products and people who perhaps wouldn't. So that's refreshing. Great. Let's see. And Wei, I know that prior to joining BlackRock, you were in equity derivatives. And one thing that sort of becomes interesting when vol rises is optionality. So I wanted to ask you, how do ETFs compare with things like derivatives during volatile times? And is it sort of like, can you achieve the same kinds of things with an ETF that you can with, say, going long an option? Or is it kind of like an either-or proposition?
I wouldn't call them either or at all, because derivatives on ETFs, this market has also been developing. We have a very well-established option market on ETFs and increasingly futures on ETFs as well. So some of the benefits that derivative products provide, such as you want to rent the market and not only the market if you're worried about where the market is heading towards, increasingly you can get that through ETF backed up kind of structure as well. And in terms of at times of volatility, how ETFs perform, the best example that came to my mind, the latest example, is actually what happened back in February earlier this year, and the week ending on February the 9th. If you look at kind of the exchange traded volume in the US, it's about $1 trillion in that week, which is twice the amount versus historical average, but the actual underlying redemption activity is only 30 billion. So it's a very small fraction of actually what exchanged on, in the secondary market. And it goes to show that at times of stress, ETFs are what investors turn to express their views, and also have acted as shock absorbers as well to smooth out some of the actions. And whatever that happens on the secondary market are really representative of exchange of hands of ownership, but does not necessarily represent the trading of the underlying exposure. And that link is really important to make clear.
Yeah, and that optionality is kind of what the ETF ecosystem that they talk about. I mean, how important is that at JP, promoting the sort of existence of all these kind of corollary things around?
Yeah, well, I think it's great for the entire ecosystem. I don't think it's unique to JP. I think we're kind of all in this together, right? And I do think that you make the great point that with this new technology, the fact that we can match buyers and sellers on an exchange so that risk can be appropriately repositioned is a really important thing. We're not adding liquidity, we're just adding convenience of trading. We still deal in the primary. If you place a trade and the ETF grows or shrinks, it still goes through the same exact JP Morgan dealing desk that a mutual fund trade would go through, right? It's the same desk. But what we've done is we've introduced this secondary liquidity to better match buyers and sellers during those heavy trading times. And that's proven to be a very efficient way for money to move around in the market.
And Will, as a user of ETFs, I mean, how much do you take advantage of the sort of ecosystem there, the optionality, the ability to short ETFs? Is that important to you?
I mean, Bryon made this point. Both the guys made this point earlier. As an investor, what you want, and when we have tactical discussions, we're looking for, they start in the theoretical. What can or what should we do? And then you get to what can we do? And these guys are providing us with the ability to do an awful lot more in a sense, and so that's got to be a good thing.
Yeah, great. And actually, we have great timing for this panel, given what happened yesterday and this morning in China. And in fact, I wanted to ask you guys, what are you doing now? What have you been sort of perhaps recommending in the days leading up to today? What did you do yesterday? Anything you could share with the audience I know would be interesting.
Stared at the screen in horror, mainly. No, so on Friday, what we did, we actually took a little bit of risk out of portfolios on Friday. And what we did is we've had a long held overweight to US stocks, pretty much the entire cycle, actually. And we've reduced that to almost neutral. We put a little bit into cash and a little bit into EM. And the basic theory here is that actually, against looking at that bond market move, that sharp rise in real rates, if you look underneath the bonnet, looking there, it's not term premium or real or inflation risk that seems to increase. It's the market's estimation of where the choke point for the US economy is. So to that extent, the bond market is actually giving us a slightly positive message for growth, as is the other indicators. And our belief is that the US economy is just too big, too interlinked, too important to grow, to boom in isolation for long. And so that divergence you've seen between US and emerging market equities, that's probably not durable. Although what you're seeing right now is a little bit of a panic. I think this is not, we wouldn't say that this looks like the end of the cycle. You still look like you've got a bit to go. And so the key for investors at the moment, really, and ETFs are part of this story, is you've got to try this last stage of the economic cycle is a really difficult one for asset allocators, because what you've got to do is it's coming, but you've got to try and keep the skin in the game for as long as possible, because it's an incredibly profitable period of the cycle to be invested through if you can keep your nerve. But all the time you're using that strength to rein in the portfolio's horns a little bit. And like I say, the flexibility that the sort of ETF products are providing us is part of the story that allows us just to be a little bit more nimble around that period.
I will pick up from what you said, Will. It's not the end of the cycle. We also have the same view in that we think the remainder of the cycle should be measured in years rather than in quarters, although the S behind the year, we can debate about that. And as a result of that, it definitely pays to stay invested in market. And frankly, given how markets have done so far, investors can't afford to stay out of the market. Now, having said that, we talked about various drivers of volatility so far this year, and this is precisely why we also have the view that in addition to wanting to stay invested in markets, it's important to build portfolio resilience. So what do I mean by that? It's important to be selective in where you want to own, which part of the market you want to own, where you see it pays to stay invested. And with that being the case, we have a preference for equity over bonds more broadly, and within equities, we have the preference for US equity market and emerging market equity market, but we want to play it through up in quality type of tilt. So specifically, quality as a factor is what we would favor, and we also understand that at times like this, it's important to have that diversifier in your portfolio. So short end of the curve, especially after recent rates backing up, it's looking interesting and attractive. And other diversifiers, commodities and gold, they may not go significantly higher from here, but definitely worthwhile having that part of your portfolio allocated to diversifying exposures.
Okay, great. And so we've got actually a couple of questions from the audience that this might be interesting to hear. And I think to some extent we've covered this, but we have a question. Is passive a misnomer, considering how many active decisions go into creation and implementation of an ETF? Bryon, I feel like you may want
to So the S&P 500, which is kind of the most generally referred to, or at least the picture that most people have in their heads when they say passive, was invented in the 1920s. It only had 233 stocks in it, didn't expand to 500 securities until 1950. S&P still has a committee that actually decides what goes in and out, which kind of sounds active to me. And so there are more and more rules being embedded in the indexes. I think the important distinction is the implementation. Is it 100% rules-based and then therefore tracking an index? And then you understand that we're in smart beta or strategic beta world. Is it 100% market cap weighted, i.e. just the cap weighting of a benchmark? Then you're in what I'll call pure passive world. And then there's a threshold in my mind where as soon as a human being has discretion over the portfolio, even if it's 99% rules-based or systematic, but they say, oh, but by the way, I don't want that stock, you've entered active world. And so I think it's just important for us to distinguish those three buckets. But as Wei pointed out earlier, the lines between each of those are getting blurred. Just to finish that, the more important piece is the asset allocation on top of that. That we all know drives about 80% of your returns, less about the implementation and the different sleeves. So
I was just going to comment that you may have noticed that I went through the whole panel without actually using the word passive. And given that you can be active with passive, I hope today the event marks the moment where we use indexing to replace passive as a term going forward.